You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
You wanted it, you got it. A radio program that helps teach you options trading inside and out. Basic to complex. This is Options Bootcamp. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo and Dan Passarelli.
All right, everybody. Welcome back to Options Bootcamp, the program here on the Options Insider Radio Network, where we take you, the proverbial retail stock trader, and we break you down horribly, physically, violently, and indeed mentally. And then we rebuild you into seasoned options veterans. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting, ever-expanding 13, soon to be 14, maybe even by tomorrow if we play our cards right, programs here on the old Options Insider Radio Network. And where can you find all of that options-oriented goodness? Well, of course, the easiest place, the mothership, the flagship, theoptionsinsider.com. You have legion of places you can find the radio, Insider Radio Network tab, top left corner, the call out on the right side, or even that player right in the middle of the page there where that shows you what the most recent episode on the network is. To hit play on that. Chances are you'll get my co-host here, Mr. Passarelli, doing his Options News Rundown. We'll get to him in a second. He's up there quite a bit, but also there's a lot of breaking news from the options market there, education, analysis, unusual activity. We got quite a bit for you. So if you haven't been there in a while, then surf on over. Click around, read some stories, read some breaking news. I think you're going to like it. Of course, you can always find our content pretty much wherever you find your favorite podcast programs, iTunes, TuneIn, Stitcher, Pocket Cast, Downcast. I don't care how you get it. Even via our mobile app available for iOS, Android, and the Fire OS. No matter how you go out and get your podcast, we're probably there, including soon to be the new Google Play podcast store. Whenever they turn that on, we should be there. And if you're not seeing us, let us know. We'll make sure you're there. And pretty much any device imaginable, we're there. So check us out. And of course, while you're listening, while you're streaming, whether it's through the app, the website, what have you, send us your questions, your comments. We love to hear from you guys. In fact, a good portion of this bootcamp show is about what you guys want to talk about. So without you guys, we wouldn't have much of a show. So write in with those questions or comments, email, twitter.com/options, facebook.com/theoptionsinsider, questions at theoptionsinsider.com, or pretty much just hit us up on the website. No shortage of ways to make your voices heard, just like this guy who's making his voice heard quite a bit on our network. You probably have checked him out on his daily Options News Rundown. Dan is the man who chooses the stories that are most suitable to start your options day. And now he's here with us once again to talk about some fun edumacation in the realm of options. He, of course, Mr. Dan Passarelli, the founder of Market Taker Mentoring, a.k.a. MTM. Mr. Passarelli, welcome back to the Options Bootcamp program, sir. It has been far too long.
Hello, Mark. Hello, listeners. Hello, everyone out there in radio/podcast/internet land. We have got an exciting show planned for you today. It's a gosh darn beautiful day in Chicago, which is something I haven't been able to say for several months. And I'm ready to get going. What do you say, Mark?
I'm ready. I am set. I have my whistle. I have my white hat. You have your black hat. So we're good to go. We're ready to head on to the drill instructor proving ground for some basic training.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Pull in, print barrel
right, everybody. Welcome to the basic training segment. Like the name implies, this is the portion of the program where we give you guys some basic options, tips, maybe review some concepts and some strategies and some things that you guys can put to use right now in your own trading accounts. And Dan, you know, I've been traveling hither and yon a lot lately, going to a lot of conferences and events and getting a lot of data sent my way too. And it seems like, and maybe you've had this same feeling as well. I think if you could summarize the last month or two in the world, in the options world, there are a couple of things you could maybe talk about. But one of the things that comes to mind for me is pretty much this has been, I guess you can call it almost the year of the put. In particular, the year of the short put. I've come across more data and more studies and more presentations about the efficacy and effectiveness and outperformance of your plain old vanilla short put strategy in the last month or two than I have probably in the previous 3 or 4 or 5 years combined. I'm not sure if there's something in the water or what it is, or everyone is awakening to this fact simultaneously, but it seems like short puts are just the trade du jour. Is that your take as well? Have you been encountering just this flood of short put love?
I have, and it's been kind of interesting. I mean, I think that there's a very clear and obvious answer as to why there's been so much information on short puts recently. But before I give that to you, I kind of want to point out that, you know, obviously the market has been rather volatile since late August of 2015. And there's kind of been a little bit of a bloodletting in short puts. You know, I have mixed emotions about short puts. There's some students that I tell based on their objectives, you're crazy for doing short puts. And then there's some students that I tell based on their objectives, short puts are a fantastic idea for you, you know. As far as why, and so the people who've been doing it for the wrong reasons learned that it's a wrong reason because they got really bitten behind a few times over the past several months, and they're not doing it anymore. The people who were doing it right really met their objectives and are doing great because of it. Now, here's why I think there has been so much data out there on short puts. You got to consider that these studies take a while to develop. It's not like somebody wakes up, rubs the sleep out of their eyes and says, I'm going to write a white paper in the next 3 hours on the efficacies of short puts and why they're so fantastic. And they come up with a 50-page white paper with all this data. And next thing you know, it's disseminated to the world. I mean, they take months and such of research and that kind of thing. Now, when these started coming out, you know, I mean, I saw a few of them maybe a year ago or so. That was when we're in the process of enjoying about a 4-year run where the market did nothing but go up with high implied volatility. It was a put seller's dream. So that's why right now we're hearing about how great put selling is because, you know, I mean, I don't have a chart in front of me right now, but as I recall, 2012 to the middle of 2011 to the middle of 2015, if all you did was sell puts, holy cow, you did really great because you had Delta and Vega on your side and Theta on your side. But now it's become a little bit more dicey and it's become a little bit more tricky and you really have to know what you're doing. And so that leads us to a really fun and interesting conversation today.
Yeah, you know, I look back through our archives because I have been so bombarded with data recently on short puts. And we've touched on these in various capacities over the years, you know, in adjustments and as part of various strategies, like maybe the quote unquote covered combo, we have the extra short leg. So there's short puts involved in a lot of the things we're talking about, but you and I haven't sat down on this program and really dissected the short put as a strategy in and of itself almost for 4 years, Dan. It's been since episode 4 of May back in May of 2012.
Wow.
So it's been that long since you and I have really sat down. So I thought we're overdue for a revisiting on all things short put. By the way, listeners, if you want a kind of complete breakdown of the short put and all of its, you know, pros and cons and the really deep dive into the strategy itself, we're going to touch on that a little bit here, but really going to talk more about some of the latter data we found and some of the efficacy and maybe if that changes our opinions or not. But again, go down to episode 4. You can find that on our website. It might be hard to find in iTunes. Sometimes they limit the number of archives that they show in that one page. So maybe the best place is indeed to go to our website. Our or of course our app will have all the episodes there as well. So scroll down, you guys scroll back a little bit. We got quite a few episodes of the show here, and you'll find that episode 4. Download that and stream that. Maybe pause this, listen to that, then come on back to here. But really quickly, we can of course do a quick synopsis for our listeners, in case Dan, there are 2 or 3 people out there who don't know what the heck we're talking about. Let's do a quick overview right now, really quickly. What the heck are we talking about with your basic short put? You don't even have to get into a covered put or a cash secured put, essentially, Dan. Just talk about a basic short put for the 1 or 2 people out there who may be scratching their heads and apparently are too lazy to go find episode 4.
Sure. So those of you who are pretty new to options, consider what a put is. A put, if I buy a put, I'm buying the right to sell a stock to someone. Now, if I buy a put, there's someone else somewhere in the world who's selling it to me. There's always 2 parties to each of these trades, each of these contracts. And so it's actually very common for retail people to sell puts. So if I'm the person who's selling the put to the buyer, then I'm selling him the right to sell to me the stock at the strike price. So basically what I'm doing is I'm taking on an obligation to buy 100 shares of the given stock at the strike price, and I can be assigned, the stock can be put to me anytime between now and expiration. So I might have to buy the stock and I collect a premium for that risk.
Yeah, it's effectively another way to work a limit buy order in an underlying, something that I know a lot of you out there coming from the stock world are very familiar with. You know, you probably do that every day in your various accounts, trading, retirement, etc. You see Apple is trading here, you want to buy it here, you work a limit buy order. It's very straightforward, very simple. You can think of a put in very simple terms as being analogous to that. Now, one of the reasons I'm glad I wanted to save this topic for debate with you, Dan, is because, or discussion here on the show, is because I know you're not a huge, you're not going to come to me and be just singing all the praises of short puts all the time. You're going to really, you take a little bit of a contrary viewpoint to that, which I think is good. I want to have a little bit of a discussion on this topic here on the program. And, you know, of course, the flip side to what Dan just said, you know, of the writing that put is, you know, this strategy has been painted, viewed, seen by many for years as being effectively a very, very highly risky strategy, and a strategy that adds a tremendous amount of risk to a portfolio. They don't see it in the terms we just laid it out, which is, you know, very much being analogous to working a limit buy order in a stock. Heck, we've all learned, we've had it displayed to us multiple times just over the past few years. Of course, the flash crash back in 2010, then this last August as well, when the market Dow opened off 1,000 handles. We've all been shown the risks of just a simple limit order in a stock. So there's risk no matter what you're doing out there. And so the notion that short puts are somehow the only risky thing out there is kind of funny. I'd also encourage you listeners to go find our episodes on synthetics, where Dan and I talk about, you may be listening to this and saying, hey, you know, that sounds interesting, the short put, but I don't do that. That's too risky. I just do covered calls. I buy stock and I sell calls against it. Well, surprise, surprise. Synthetically, they are identical from a risk perspective. So maybe if you don't understand what I'm talking about there, check out our episode on synthetics. We've done a few of them, actually. Just go through our archives, the website, iTunes, wherever you find the program, maybe the app, and you'll search for synthetics, and you'll see it right there. It's a scary term, I know, but it really kind of puts things in perspective in terms of how a covered call, short put, exactly the same thing. So, Dan, let's fast forward now. We've kind of touched on a little brief overview of what the heck a short put is. If they want more detail on it, again, go find episode 4. We just spent a whole hour on it pretty much. But now fast forward to here we are, 2016, and the data has been coming in. The first one that kind of caught my eye was a few months back. I think we touched on it briefly on a recent episode, but it was a study coming out of the SIBO. It was effectively called an analysis of index option writing with monthly and weekly rollover. And again, it kind of really puts some interesting perspective on some of these claims that have been levied against short puts for a long time, that they are extremely risk additive to a portfolio. Only a fool sells puts. you're just going to blow yourself out if you do this. What they found in this study, of course, from an income perspective, short puts were very effective, obviously, and they also added a corollary to it where they also looked at the weeklies versus the monthlies. They found the weeklies outperformed in a variety of ways, including in the income. Again, going back to what we said on the show many times, if you're writing premium, you probably want to be closer to that exponential portion of the decay curve to really maximize your income. That portion of the study, very, very interesting in and of itself. What they also found, though, is that longer term, looking back at the longer term, so they just compared straight up S&P to over, I think their period was from mid-1986 through pretty much the end of 2015, so coming on 20 years, and they found that the total growth for the S&P over that time frame. So again, you have mid-86. These are not quiet periods. You have the 87 crash in there. You have the 2000 stock market meltdown. You have 2001, obviously, the 9/11. You have 2008, 2009. So you have a lot of tumultuous periods in that nearly 20-year data set. And what they found is that the overall total growth for the S&P was about 1,622%. Excuse me, that's for the put index, the put right, which is what they analyzed against it, which is the selling an at-the-money put every month like clockwork. And if you did that over that entire period, how would that perform? And it turns out it was about 1,622%, and about just a tick under 1,500% for the S&P 500. So total return, long-term return that puts outperform, which is important because when you're talking, there's that old saying, risk-adjusted is nice, but you can't eat risk-adjusted returns. And here we have an example of the puts actually outperforming. Even in that very tumultuous period, the annual compound return of the put index, about 10.13% compared with about 9.85% for the S&P 500. And interestingly enough, people who talk about the risk side of it, standard deviation of the put index, aka one of the prominent measures of risk, was substantially lower when the put right as well, with about 10.16% versus the S&P. This is just straight up naked buying S&P, SPX, SPY, however you want to do it, S&P future, 15.25%. So substantially less from a risk perspective. Also looking now at maximum drawdown, same thing for the put index. It was substantially less than it was about, it looks like here on this chart, back in 2009, the maximum drawdown was about a little over 30% compared to just about 50% for the S&P by itself. And they crunch a lot of data as to why that's effective. If you've listened to this show over the years, we've talked about things like volatility skew. And a lot of these products they're looking at, particularly the indexes and the equity options, have what we call investment skew, aka the volatility premium in the puts is going to be substantially higher than it is in the calls. So if you're selling those puts over time that have inflated volatility premium, that's going to accrete to you in the long term. They found another study coming out of the SIBO again, kind of backing that up, looking at the Russell this time. This was about a month later. They looked at Russell and found pretty much very similar type data. They found lower volatility in writing PUTR this time, which is the put right index on the Russell 2000. So they compared owning the Russell 2000 versus writing monthly and weekly at the money puts on the Russell 2000. And net, same findings over, I think their period was about 15 years. They found, so they had 2001, 2008, 2009. They didn't have 87. But they had about, I'm looking here at the numbers, they had about, same thing, higher returns, lower volatility, and indeed a higher Sharpe ratio than both the Russell by itself and even a Citigroup 30-year Treasury bond index, something that is seen as kind of universally lower risk. So interesting data. Also, Dan, I spent some time at the Risk Management Conference this past month as well down in Florida. And if you could pretty much sum up the theme of that conference in one pretty much fell swoop, it was pretty much presentation after presentation on the efficacy of short puts. And that conference is geared towards institutional asset managers and money managers. And it was pretty much like their eyes were being opened to the first time to this strategy that's been around forever, the data and the efficacy of short puts. So it's been kind of an interesting time for me. And Dan, I know, again, you're kind of a bit of a point counterpoint on the short puts. I'm curious what your thoughts are, A, on all of this data coming out right now, and then B, has it made you look again, perhaps at the short put as a strategy, and has it involved your thinking at all?
No, I mean, the data that's coming out hasn't really changed my thinking any. I mean, it reaffirmed what I've already known, as far as me being a point counterpoint person on the put, it's mainly being a point counterpoint person just within my own head, or rather, I guess to be more accurate, depending on who I'm talking to and what their objectives are. Right now, I mean, I've got short puts on right now in my IRA because this is a fantastic time to be using short puts intermittently, not just blanket universally. That's where a lot of the mistakes happen. People say, oh, hey, all I do is sell short puts, month after month. I'm not a big fan of that, even though the data says that statistically in the long run overall, you can outperform. You can, but I think you can even more outperform if you overlay a little bit of common sense over that. Sell short puts when you want to actually buy a stock. So wait until stocks dip, wait until implied volatility is higher, enter a short put at a strike price that you actually would like to buy the stock, and then actually hope you get assigned. Now, here is, and I probably said this back in episode 4, because this is sort of, just one of the things that I find myself talking about over and over and over again with people about short puts, is the difference as to whether they're great or horrible has to do with what's between your ears, with your objective. It's not how you do it, it's why you do it. The problem that a lot of people run into, that most people run into and do wrong with short puts, is they say, oh yeah, I learned about short puts and the guy told me that if I'm happy buying a stock there, then short puts is a good idea, which is true. But then I think a lot of people kind of trick themselves and they say, oh yeah, okay, well, I'm going to sell this 10 lot of puts at, $1 here, so I can make $1,000 when they expire worthless. And then, of course, the stock really tanks for whatever reason, and they end up losing $7,000. And they say, what the hell just happened here? How did I lose $7,000? Jesus, this is terrible. What's going on here? And they ended up getting assigned and buying the stock, and it's the end of the freaking world to them. But that's not the agreement they made. That's not the agreement they made with themselves. The agreement they made with themselves putting the trade on is, I would be happy owning the stock here. So, there's no crying in trading. If you say I'd be happy owning the stock there, don't be upset when you own the stock there. And, that happened to me. I mean, I've been doing puts since August of last year, selling cash secured puts since August of last year in my IRA. And you're never going to be right. You're always going to get assigned on your puts and look at it and be like, oh, well, looks like I ended up buying higher than where the market is right now. But that's okay, because you bought way lower than where the market was when you put in the put order, and then you wait for the market to bounce back. Selling puts, cash secured puts, can be a very conservative long-term investment strategy that can work out freaking great if you're smart about it and you're controlled about it and you're not worried about making sure you buy the absolute bottom. And, if you're ever upset that you got assigned, you're doing it wrong. You have no business selling short puts.
Yeah, I think that's kind of a good starting point for a lot of our listeners who are listening to this show and they're saying, well, I don't know, should I do this? Should I not? And the data says yes, but I'm kind of scared. You're right. Look at it as I've said many times, as the alternative to the entry point for stock. So if you like XYZ stock, if it's trading $50 and you say to yourself, yeah, I wouldn't mind buying it at 45. I'm going to work my limit buy order at 45. Now instead you look at it and say, well, in the next month or two, I'm going to, I would buy it there at that price. I'm going to sell this 2-month put and maybe you get 50 cents. And so now effectively you're working a limit buy order at 44.50 because you take a 45 strike minus 50 cents you just collected, and you've lowered your price, A, which is nice, and B, you got compensated for, which is at the end of the day you are taking risk. Like we said, with all these limit orders, these stub orders you have hanging out there, that's risk. You should be compensated for it. And so if you're going to just work stock orders, options are a much more effective way to do that. And then, of course, you can turn around and get into some strategies we've talked about on this show in the past. Wheel trade, our friends at RCM call it the triple income trade. Call it what you will. You get paid to get into the position, maybe get some appreciation out of it, and then get paid to get out through a covered call. So you get income on both legs. There's many ways you can use options in these scenarios. But the key is to start off, I think, with that stock mindset that you have. And like Dan's alluded to, where people kind of get into trouble with these is when they start, seeing the the income stream they're creating for themselves, and they're saying, well, I kind of like this. I'm going to do this more often, more frequently on names I really don't have any intention of ever owning, and doing it maybe more than I should to like max margin in my account, max buying power, and just going full to the hilt, swinging for the fences. That's where the people get, or, start to really expose themselves to some needless risk in this scenario. And you and I have both seen it countless times, Dan, where people, use it in the wrong way, and we see it a lot with the weeklies now. I'd lion's share of the weekly use case is selling weekly puts, and some of those people want to buy that stock. Some of them are just harvesting premium, and there's an interesting conversation to be had there. Again, the data does help to show you that it isn't perhaps as risky as you thought, but still you can make it much more risky if you take the wrong approach to this kind of thing. So I think starting from that perspective of buying the stock, and again, what you mentioned, cash secured is just another flavor of a short put, listeners. That's effectively where you're saying, I'm going to leave enough cash in my account to buy this stock at that strike price I just sold the put at. So in case I do get assigned, I have the money there. So effectively, you are, in that sense, really working a limit buy order for the stock. Now, there's a downside to that. Obviously, you're tying up some capital for that. So bear that in mind when you're doing these strategies, and maybe that'll make the income you're generating maybe a little bit less attractive, tying up all that capital. But again, that's an effective way to do this, particularly in an account like an IRA. We'll get to IRA trading in a little bit if we have some time for the mail calls here. But still, it's an interesting field, Dan. We could probably spend many episodes talking about this. There are people out there I know who are serious professionals in the options world, and they would never consider buying on option in a million years. They only sell them, and they view that notion of the risk premium in the marketplace, that implied volatility is always going to be greater than realized in 99% of scenarios, and short puts put wing have the highest amount of implied volatility. Therefore, selling puts is the most effective strategy, and they do it till the pigs fly, essentially. So there are people that will never be dissuaded by that, and some of this data coming out may be interesting to them. But if some large money managers, Dan, are starting to learn some of the basics of this kind of stuff and saying, hey, instead of working a buy order for my stock in XYZ name for hundreds of thousands or millions of shares, I can write 10,000 puts maybe instead. That's a lesson that's worth learning for them, and I think over time that will accrete to our listeners too, who have big mutual funds or 401ks or whatever the case may be, because their money managers are being more effective with their use case, and they're using options to do that. So yeah, it's an interesting topic. I just kind of wanted to highlight this data yet again, because a lot of you may have seen this tangentially, maybe on our site, or heard bits of it on our network, or seen it elsewhere on the SIBO website, or wherever you may have come across it, and said, wow, that's completely changed my thinking on puts, and I could just write puts all day and I'll never blow out. That's not what this data is saying. Don't misread it. In fact, some of the data, like the Russell study, you have to dig into it a little bit to see that. You talk about risk-adjusted returns and things, and they talk about net premium, but I think over that same period, I think in the Russell case, the put writing strategy actually underperformed from a certain overall return perspective once you start looking at some of the other measures in there. So dig into the studies a little bit too to make sure you understand exactly what you're saying. It's not just a free bonanza of income writing puts all the time. But if you were on the fence about at least embracing this strategy and maybe starting off going on the route of, hey, I'm going to sell a put in order to maybe buy a stock here, and like Dan says, make sure that's your use case to start with, because that's the best way to go. You can't get mad at yourself because you did your homework, you sold it at a strike you want to buy at, and it's the same thing as working a limit buy. You don't get mad if you get filled on your buy order in a stock. Why would you get mad if you get signed on a put? It just doesn't make sense. And you actually probably lowered your effective buying price of the stock, and you got paid a little bit to do that. It's a nice thing. So over time, that's your starting point. That's an excellent way to get started with this. And this data will probably just help ease your mind. And if you're a covered call seller, well, then you should be doing this anyway, because you're doing the same thing to begin with, and you could free up a lot of capital by doing it this way instead of buying the stock and selling the call and all the capital that is inherent in that as well. So there's a lot of reasons why people may want to migrate to this style of trading, but it's not for everyone. You could certainly do it wrong and force it in times when you shouldn't be doing this, trying to get that income every week, regardless of what market conditions we're in or whether you're really getting paid enough for the risk you're taking. If you start going down that road, then, of course, it gets a little dangerous. Of course, there's also ways you can mitigate that risk. You can sell put spreads instead of puts. Then your risk is very limited, but, of course, your income is going to be limited as well, so you can look into it that way as well. You can use the short put as a point of entry into other strategies. Maybe one of my own personal favorites, the bullish risk reversal. So you sell that put, use that premium you're collecting to buy a call in that same month or a different month perhaps, and the cost of that call is going to be dramatically reduced, perhaps even free, maybe even a credit, because again, looking at puts versus calls, a put should have a higher implied volatility premium than the call. So if you're selling the put, buying the call, you should probably collect on that, or at the very least maybe break even. So now you have a low cost or perhaps even free, perhaps even a credit, getting paid to get a long premium position, a long delta position in an underlying like that. It's much more effective from a capital perspective than buying the stock outright. So there's a lot of things you could do starting with this short put leg, but it's something to consider in your strategies over time. And certainly if you're out there just working stock orders willy-nilly, you should definitely be doing this, because this by itself, if you do nothing else that we talk about on this show, will improve your returns over time and just be a much more effective way for you to go. If you're working a stock order $5 below the money for 2 months and nothing happens, you don't get filled, guess what? You got nothing for that. If you sell the put in that time and nothing happens, it doesn't go to your strike, you still collected some premium for that. So you were compensated for your risk, which is an important thing. Dan, we can go on this forever, but I want to get some listener mail too. So maybe give me your final thoughts, your wrap up here on short puts and the pros and cons and your overall view on them, even in light of this new data.
Yeah, I mean, I would say that both you and I really kind of covered the important things. I mean, I think we both sort of said the same thing in different ways and really fleshed out the idea that the important thing is, look, man, it is a way to acquire a stock and, work limit order and get paid if you don't get filled on it. It has all the risk associated with owning a stock. If you are comfortable owning a stock, you're comfortable selling short puts, but you really have to literally not just convince yourself that you're okay if you get assigned because that's the risk. No, you have to want to get assigned. And if you do want to get assigned and you do get assigned, then you're happy about it. And options can really, really make a good positive impact on your long-term investing.
All right, speaking of making a positive impact, let's make an impact on some of our listeners' lives, Dan. Let's get into the mail call.
Mail call. Time to look at questions submitted by our listeners.
I love that theme, Dan, because it makes me think of just 4th of July, whenever we do it, and fireworks and summertime in Chicago and all those fun things, which in the depths of winter can sometimes be a nice, refreshing thought. Of course, welcome to the mail call portion of the show where you guys dictate what the heck we talk about with your questions, your comments. If you want to be part of this, then hit us up. Like I said at the top of the show, no shortage of ways for you guys to hit us up. If you have the app, you pretty much got it all at your fingertips already. Just use the app and reach out to us. Or find us questions at theoptionsinsider.com, twitter.com/options, facebook.com/theoptionsinsider, or on Stock Twits, we are Options Insider. I know there are different handles for all of them. That's kind of just the way it all works out. So maybe easiest to find us on Twitter, just add Options. Can't forget that. And, of course, you can always hit us up on the website. You leave a comment or use the website feedback form. No shortage of ways to make your questions known. Just like this timely one from QKT. He says, if I sold $1 strike put with a current trading price of 50 cents and then the stock goes to $5, what happens and what is my risk? How do I look at expiration? Can my puts be exercised against me? Well, very timely question because we just talked about short puts the whole time. So he's saying if it's a stock, if he sells a strike put the $1, collects 50 cents to do it, it's a pretty hefty premium. The stock must be at the risk of going to zero pretty quickly. And then the stock turns around and rallies up to $5. What happens? Well, first off, you're a happy camper because you just pocketed 50 cents. That's pretty much your best case scenario in that moment there. You don't mention if it dips below that strike first or anything like that, but overall, you're a happy camper if you held on to it that whole time because you just collected 50 cents, free and clear. That put's going to zero. How do you look at expiration? Again, you're happy. Your put's worthless that you sold. You collected 50 cents. Your stock's way above your strike. You're a happy camper. Can my puts be exercised against? I think he meant to say assigned there. So I'm going to assume that's what he meant. And so can your puts be assigned again? Well, let's think about that. If your puts are assigned, when you short a put, the person you're selling it to, you're effectively guaranteeing them the right to sell that option at any time during its life at that strike price. So you're guaranteeing effectively to buy the stock there. If the stock at expiration is trading $5, does someone really want to sell it to you at $1? Probably not. If they do, you are, that again, a very happy camper because you didn't just make 50 cents. You just made $4 because you could buy it for $1 all day and sell it for $5 in the marketplace all day long. So in this scenario, if all these things come to pass, you're a super happy person, and quite frankly, very lucky. You just kind of won the lottery of options as well, because very rarely does someone go off the rails with a crazy assignment like that. But if that's the case, yeah, you're a happy camper, QKT. So yeah, be thankful. Hopefully this happened to you. Hopefully this is a real life scenario you sent to us. All right, moving on here. That was an easy one. Let's go to Nick S. He writes, I'm thinking of a cool new strategy. Uh-oh, Dan. Put on your thinking caps. New strategy coming. He says that I haven't seen listed online before. It effectively involves buying an iron butterfly, and he puts in parentheses, one of Mark's favorite strategies. He's right. I do love myself a good iron fly. It's up there with my bullish risk reversal is some of one of my favorite positions. And he goes on to say, and then selling an extra put on the downside leg. You'd select your strike at a price where you're comfortable, got a little typo here, buying the stock should it drop. This has the obvious benefit of reducing your initial outlay for the position. However, unlike a naked short put, you have the added cushion of the long straddle to help you on the downside and lower your effective break even on the downside. This is an interesting one, Dan. It kind of is relevant to what we're talking about here in short puts. This strategy is going to have a naked short leg to the downside. If you're not familiar with an iron butterfly, really quickly, it's effectively an at-the-money straddle versus an out-of-the-money strangle. So in this case, he's talking about buying an at-the-money straddle and then selling an out-of-the-money strangle. So you can see how your profit is limited. Also, your risk is limited in that scenario. So it's a nice thing. Now, what he's talking about is now selling an extra put on the outside leg of that straddle, or that strangle. So now it'll be long a straddle, short a strangle, and then short an extra put on the downside. Now, as he says, that has a couple of benefits. It's going to reduce his overall cost for the position, which may be attractive. It's also going to expose him to the downside. If the stock drops, he's going to be buying it there. But in this scenario, he has, as he refers to it, a cushion where because he's making money in that straddle all the way to where that extra short put strike is. So in this case, he doesn't say how wide it is. Let's assume he does it for $1 wide. He makes effectively $1 on that straddle before he hits his extra short leg. So now the stock can drop an extra $1 against him, and he still will effectively break even on that trade. So it's an interesting idea. I've seen this before. Off the top of my head, I can't think of any type of name for it other than a ratio kind of iron fly or something along those lines. But Dan, I've been talking for a while. What are your thoughts here on this extra short put kicker iron fly?
Well, I mean, all different option strategies exist because there's a specific market scenario that's appropriate for each of them. This one sounds like a pretty darn unique scenario. I mean, it's definitely not the kind of strategy that you're going to have 7 of them on right now, and when they're expire, you're going to roll into another bunch of them. It's probably one of these strategies that once or twice a year, you come up with a scenario where, I guess probably the best way to do this is by, putting on this trade that this guy's talking about. But I mean, I don't think it has any systematic advantages over any other strategies for sure. I mean, I'm not a big fan of the iron butterfly where you're buying the guts and selling the wings because you're just way better off buying a straddle, maybe buy fewer contracts worth of the straddle, because then you have unlimited profit potential. That sort of iron butterfly is saying, well, I like volatility, but not too much volatility. You're basically saying, I want to be extremely punished if the stock doesn't move, but if it does move, I want to be slightly rewarded. So it's not, I'm not a big fan of that, except for unique scenarios. And then throwing another short put on there, great until the market collapses. And then you're probably not the kind of guy who's saying, but I wanted to buy the stock there. You're the kind of guy who's going to say, what the hell? Oh, Jesus, I bought the stock here. This is terrible. So I don't know. Every crazy strategy somebody can come up with, there's definitely a situation at some point in your life where you're like, oh yeah, here's the best way to do this. But I think in general, I don't see any blatant advantages to it.
Yeah, he definitely gets points for just writing in for the long iron fly. I talk iron flies a lot. Typically, I don't buy them. Very few people write in talking about buying iron flies. So he gets a point just for talking about buying premium. So few of our listeners write in with hey, I want to buy some premium. So he gets a point on that. You're right. I'm not a huge fan overall, unless there's some interesting scenarios, and there could be, you could structure this in a lot of different ways. You could move the long premium portion out a little bit, maybe focus the nearer term portion on the short legs and then kind of keep rolling them to get back to what we were talking about before, the theta advantage, and maybe there's some structural reason you want to do that, and you don't mention a particular underlying, so it's kind of hard to comment just specifically on any use case. But it's an interesting idea, and again, you get points for writing in saying you're going to buy premium as opposed to everyone else writing in saying they just want to sell premium all day. And at least you're thinking of some ways to mitigate it, and you do have that extra short leg, but it's not the same thing as just going out and writing a put because, like you said, you have that straddle. It will hopefully, in the worst case scenario, shield you against at least some of that downside you're looking at. Interesting strategy, interesting idea. Again, premium buying, get a point for that, even that's not the way I would use it, but interesting nonetheless. Good question there, Nick. We'll have to come up with a name for that. I like iron fly with a short put kicker. Iron fly, maybe short put overlay, I don't know. Call it what you will. Maybe listeners, write in with your own name for that strategy. We're going to keep rolling, see if we can squeeze a few more in here. This one comes from AJ. I won't even pretend to try to pronounce that last name. It is a mouthful of consonants and syllables. We'll just say AJM. He says, I have a question for the drill instructors. Well, you wrote it into the right place, AJ. He goes on to write, I hope you guys can calm my frayed nerves over this DOL thing. What exactly is going on? Am I not going to be able to sell calls in my IRA anymore? Since the vast majority of my assets are in retirement accounts, this would be a huge, and you put it in caps, hit to my savings. Please tell me this is not the case. If there is anything as a retail stock and option trader can do to help prevent this? What if I open an international trading account? Would that do the trick? Help, I need the drill instructors to talk me off the ledge. Dan, I'm not sure how familiar you are, how much you've been following this Department of Labor thing, which is what he's referring to with the DOL. I'll do a quick synopsis here on the show. But in general, last year, about into Q3 or so, or Q2 into Q3, the Department of Labor, which of all things was kind of surprising in and of itself. Most people expect financial regulation to come from the SEC or CFTC or FINRA or some other regulatory body. The Department of Labor kind of coming out of left field with what they term a fiduciary proposal, effectively trying to curb a lot of the excesses they see in the paid investment management financial advisor, which is a laudable goal, good thing they wanted to do. As part of that massive crackdown, and their proposal was huge and vast. The area that he's talking about that concerned us, obviously, was the part that impacted listed options. They effectively listed, they had a list of, I think it was about 44 different assets. I'm not sure why they did this, but they made a list. Whenever you make a list, people are going to get upset with what you leave off the list, and that's exactly what they did. They made a list of about 44 or so assets that you could use as a fiduciary and recommend to your clients. So that meant you could recommend to them crazy things, obviously stocks, but also variable annuities, which we all know use derivatives, all these things, and they didn't list listed options in that list. So as you might imagine, the industry went crazy. The trading firms and brokers and exchanges all went crazy. A lot of lobbying down in Congress to try to fix this. Comment letters through the roof. We had a lot of response on our network as well from shows like The Advisor's Option, where we talk about this in a little bit more depth. And people were really up in arms, including people like you, AJ, who like to trade in your trading account. There's no reason, or in your IRA account, There's no reason you shouldn't be able to write a call in your IRA account. In fact, that's a great thing. You should be doing that. You should be able to buy a put in your IRA account. It's foolish to think that you could ban these products from those accounts. And that's effectively what that would have done. And when you wrote this in, I think a little while ago, the writing was still on the wall for what was going to come out of that proposal. And we were concerned because it seemed like even though there was a lot of opposition to it, they were going to keep that proposal as is and effectively limit your ability to trade options in an IRA. Turns out, about a week ago, the proposal was finally issued in its current form. And surprise, surprise, they got the message from you guys, the retail guys, from the industry, from everyone, that people want to be able to use options in their IRA. So they added options to their list of approved assets. I think actually what they did is they removed the list, I think, which is also a preferable way. Probably the way I would have started with that. And so effectively their change that they made allowed you to continue using options and have them be recommended by your financial advisor. So long story short, AJ, I know it's too late for that, but it's a bit of a complicated tale. Long story short, AJ, you can continue to write your covered calls in your IRA, and you can be safe. Hopefully that saves you. You cannot be walked off the ledge, or you don't have to jump off the ledge now. We've walked you off. Dan, anything to contribute on this crazy Department of Labor fracas here?
Yeah, there's just a report out. Actually, So we're recording it today, April 14th. There was just a report out yesterday that said that they finally reached an agreement and options will be allowed in IRAs going forward. So that's a pretty darn good thing. I mean, options are the one tool that levels the playing field for the common man. This is the one way where you actually get to use the same tools that professional traders use. You get to protect yourself. You know, it's the one tool that you have available to protect yourself against anything. So, I mean, it is the I don't know, let's call it the working man's financial instrument. You know, it's something that would be horrible if someone tried to take away from you. You know, it would be the government just hanging you out to dry saying, sorry, you're not allowed to protect yourself. So it's a darn good thing that the rocket scientists at the Department of Labor came to terms with this and decided to allow you to protect yourself and not just be at the mercy of Wall Street to make it sound ominous, like I'm in the media or something.
I like that. A tool to level the playing field. I think that's a good way to term options. Also a good way, I think, to bring a close to this mail call segment and also, unfortunately, this episode of Options Bootcamp. I know you guys love this show. You're always asking for more. We're going to try to get you more. It's just something, Dan and I have to get our schedules together and all the other fun things that go into recording this show. And you guys clearly love it from the volume of mail you send. Keep those questions coming. We read them all if you don't get a chance to answer them on this show. And if for some reason we're not doing a boot camp for a while, I'll make sure to route your questions to some other shows where we can answer them in a more timely fashion. So you'll get your questions answered. Don't worry. Keep them coming. Email, Twitter, Facebook, all that fun stuff. And of course, via our live streaming platform, Mixlr as well, maybe MIXLR. Maybe Dan and I will hop on there to do some live streaming soon for Options Bootcamp as well. But before we go, Mr. Passarelli, give our listeners a little bit of a hint, a tease, a taste, if you will, of what's coming down the pike in the land of market taker mentoring.
Well, we're gearing up. We're starting to write our classes for our annual in-person event, which is in Telluride, Colorado, of course, this year in July. And we're getting to the point where it's your last chance to enroll. We have to give the venue that we're having this at, the hotel, a head count and a list of names. And so that all has to get wrapped up pretty far in advance. So anyone who's interested in joining us live in person in beautiful scenic Telluride, Colorado for an intense 2-day class with a networking dinner following with some industry professionals, please visit us at markettaker.com/Telluride. That's markettaker.com/Telluride.
There you go, listener. Surf on over to markettaker.com. While you're there, click around. Dan's got some good content. You get his free options blog and newsletter. Market Taker mentoring. Have you ever tried to go out and get MTM.com, Dan? I'm sure someone has it probably, but have you ever tried?
Yeah, somebody does, and it's like a stupid site. Like, I mean, if you're going to steal that from me, at least have it be like a cool site. It's some really like dumb thing.
All right, well, listeners, don't go to MTM.com. Go to markettaker.com. Again, 2 T's, market and then taker. So he's not doing a fancy spelling or anything like that. And you can click on all the stuff. And, of course, sign up for their trip to Telluride. And I'm sure, like I said, I'll be my first class, all expenses paid ticket is coming forthwith. So I'll be waiting for that. And hopefully I'll be able to join you out in Telluride as well. And on behalf of Dan, Mr. Black Hat, and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show. And, of course, for sending in such great, many, and varied questions. Keep them coming. We love to hear from you guys. You guys are really the reason that we do this program. And we'll see you next time for more Options Bootcamp.
Options Bootcamp is produced by the Options Insider, Inc. All rights reserved.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/the The Options Insider or via questions@theoptionsinsider.com.